Aloha, this is Paul Brewbaker of TZ Economics in Kailua, Hawaii. And this is a webinar originally prepared for the Kaneohe Business Group in preparation for a meeting next week, wherein we'll have a more discussion-oriented meeting. So this is background material on the economic situation that I hope you guys at Kaneohe don't mind. I will use for some other audiences with whom I'll also be having more specialized discussions, for example, about the housing market or workforce development in the next month. But this is the backdrop. This is how the Hawaii economy has changed since the pandemic began in 2020, a few aspects of that. And we'll have some more to talk about next Wednesday. And then, we'll see where the economy goes now 3 years later. COVID is still with us, but it's evolved like Pokemon. It's more contagious, evidently not more lethal. So far, so good. And I imagine we'll be talking about it for some time. Today's presentation, of course, is framed by the tragedy of the wildfire in Lahaina a couple weeks ago. And our hearts and prayers go out to families in the community, the survivors, and hope for the rebuild, whatever that's going to be. Probably not going to be the same ever, but maybe an opportunity to, after 200 years since it was established as the capital, once capital of Hawaii, a chance to start over for that important urban center in West Maui. Which brings us really to the first topic, which is fat-tailed risk. I'm not sure why everybody's surprised when crazy things happen, because they're always happening. And this is just a reminder that we should be framing all of our expectations about economic performance and framing the forecast, framing the way we think about industry performance against this backdrop of low probability, high loss events that are going to happen. With probability 1, there will be a hurricane that hits Hawaii. You just don't know when or how intense it will be. And so we've gone through this over and over again. This is the East Rift eruption of Kilauea about 4 or 5 years ago. I mean, people build their houses on a live volcano and then they're surprised when it erupts. Problems of information asymmetry abound in these situations. So immediately, superstars like Jason Momoa decide to take it upon themselves to tell everybody, don't go to Maui. And the other half of Maui is going, hey, wait, what? So these problems of misinformation or asymmetric information get amplified, particularly nowadays with social media. And so it doesn't matter what the messaging is officially from the county of Maui, or they're done, right? Everybody's canceled, and so that will complicate the rebuild. But as I say, we face these kinds of risks all the time. There will come a day when Manoa floods and the Alawai golf course, which is the holding area for that absorption, will be incapable of handling the flood. I mean, it's just a matter of time. It's flooded before. It's gone right through Hamilton Library, which was built right on top of the floodplain. I don't know why. And over the longer run, we face these gradually corrosive impacts of climate change in a number of dimensions. Sea level rise means that the Kamehameha Highway is falling into the ocean every year. I mean, it falls into the ocean at Haula every year, and it's just like a gigantic concrete seawall now, which of course accelerates the longshore current and actually makes the problem of coastal erosion worse, not better. So if you want to make the road fall into the ocean faster, put up a seawall. And so we need to be thinking about, as you know, uh, we need to everywhere, where in Hawaii, where we're stuck with a single 2-lane coast road that was laid out by horses and buggies in 1878. We need to be thinking about redundancy, right? Resilience investment is about redundancy. In part, it's about, in this case, putting a roadway up against the pali from Punaluu to Haleiwa, all the way, not just around a parking lot at Laniakea. And those of us who have had the privilege of living on the windward side of Oahu since the mid 20th century know that if you're limited to the coast road, you're vulnerable to whatever bad things might happen and leave you trapped without a way out. And people in the mid 20th century realized this, and that's why they built 6 tunnels through the Ko'olau Mountains and 12 lanes of multi-lane divided highway, the Kailua Kaneohe. I don't know why we don't do that anymore now, but there you go. So that's why you live in Kaneohe, and that's why I live in Kailua, because of bandwidth. It's as simple as that. Over on Maui, some genius decided to build half of the Lahaina bypass. So you could go all the way to Lahaina, and then you had to go down to Safeway to get on the Hono'opilani Highway and into the, into the traffic down there. When we know how that worked out. So, I mean, what happens when the wildfire comes to Nanakuli or Waianae? Bro, how many ways in and out of Leeward Oahu are there? You tell me you can't punch a tunnel through the Waianae Mountains and build a highway to, I mean, we could to the windward side in the 1950s, but we can't do that in the 21st century. So I'm just saying, you got to start thinking about this stuff. Kauai's been through this rodeo a couple times, most recently the pandemic, but Hurricane Iniki was a hard slap down in the 1990s, and it took years. You can see these are visitor counts. It took years for Kauai to recover, and it took 20 years for Kauai's visitor count to get back to where it was in 1990. Think about that for a second. It's only barely back to that level today, 25 years later. And just technically, what we're talking about, if you look at the log change of visitor arrivals, right? So you think about the growth rate of visitor arrivals, it falls into a pattern of relatively steady growth. In the case of Kauai, I think that works out to about, I want to say, let's see, what's 4 times 2, 5 or 6, 4, it's either 0.013 quarterly log, whatever's multiplied by 4, 0.024. So multiply these are quarterly data or those monthly data. I think they're monthly data. So you multiply by 12. You take the e to the whatever that is times 12, and that gives you your growth rate. But I mean, it's 0. Oops, sorry. It's it hasn't grown. It's been wandering around the desert trying to get back to where it started before Desert Storm. And as a consequence of that kind of risk exposure, neighbor island lodging has evolved differently from lodging on Oahu. Oahu lodging developed earlier in the post-World War II period with greater focus on hotels. On the neighbor island, they've moved a lot of the inventory to what in financial economics we would call securitized asset classes, right? So if you own the hotel, you own the next hurricane. If you own the hotel, you own the next tsunami. But if you sell each unit in the hotel as a condominium, then those guys own it, and you just provide lodging services, moving people through the property. Or you can take the condo and strip it into 51-week intervals, and you can call it a timeshare, or you can sell it in variable fractional intervals. And as it turns out, for the last 30 years, we haven't had any lodging growth except what I call undocumented vacation rentals seeking a pathway to citizenship, because this technology has democratized the lodging industry So your name doesn't have to be Hilton or Marriott or Hyatt or the Four Seasons, which I think is a Marriott, to hold to own lodging. You can just turn Tutu's Ohana unit into a vacation rental and use hosting apps to book people in, and the apps reduce the information asymmetry, allowing removing the barrier to entry into the industry and making it easier for people who don't have traditional lodging preferences to find your vacation rental. So it's not going away. The counties can ban it all they want, but it's not going away. And you can see what's happened because the jurisdictions, the counties, and the state have tried to stop hotel development or lodging development for the last 30 years. I mean, for 50 years, the industry grew, and then the jurisdictions have made it essentially impossible. And Maui literally does it still have a hotel moratorium? It had a hotel moratorium construction going on before the Lahaina catastrophe. I don't know if it's expired or not, but I mean, who does that? So 100 years of tourism performance leaves Hawaii in this situation where we've had no growth in tourism for 30 years. Kauai hasn't had any growth. Nobody's had any growth, not in real terms. These are real tourism expenditures from 1922 to 2021, so 100 years inclusive. And the key thing to note here is that just because you throttle growth and economic development, just because you do a slam dance on the economy, prevent people from building, say, tunnels through mountains and highways so that people have another way to escape catastrophic wildfires, just because you don't let people build doesn't mean you reduce the volatility. So look at the first quarter century after World War II in this circle over here in the center of the graphic, right? Visitor expenditure, constant dollar tourism receipts over a 30 or 40-year period grew at about there's a transition period in the 70s, but from 1949 to 1975, grew at a 15% annual rate after inflation with 8% volatility. That's that's not a bad portfolio, risk adjusted portfolio return, right? 15% yield plus or minus 8%. I mean, the S&P 500 gets 8% return plus or minus 13% volatility. So in the early post-war period for a quarter century or so, 15% annual growth in constant dollar inflation adjusted tourism receipts plus or minus 8% volatility. Well, look at the period of the 30 years between 1989 and the pre-COVID 2019, where the growth was zero. Yep, zero is zero, nothing, zero. And you still have volatility of 8%. So Hawaii traded away a portfolio that generated a 15% annual return after inflation, plus or minus 8%, for a portfolio that had a zero return, plus or minus 8%. So you still get the risk. And if Hawaii tourism were actually a portfolio, I mean, if you were just to apply portfolio analytics, calculate a Sharpe ratio, the first half century of tourism, beginning in the 1920s, would have had a rising Sharpe ratio, a rising risk-adjusted return relative to the risk-free return. And then you can see for the last half century, it's been, essentially zero. So we get all the risk, we don't get the return, and that's how Hawaii rolls. And that really frames the longer-term outlook for not just the 2020s, but out through mid-century. But let's come back from the precipice and think about more near-term issues. Obviously, inflation has been a big issue in the post-pandemic environment. So if you go back a year to 18 months, you had a pattern of Hawaii inflation that was concentrated in high inflation coming from three main components. The first was petroleum derivatives, liquid fuel prices. The second was used and new motor vehicles. And the third was food at home and to a lesser extent food away from home. So food, energy, And vehicles, kind of interestingly, well, what was happening in March 2022? First of all, the Russian invasion had just happened, so that Russian invasion of Ukraine, so that it pumped up the price of global of petroleum and global energy markets, cut off European natural gas supply, so that the energy complex was experiencing commodity inflation. The supply chain disruption from the pandemic, right, as global economies started to recover, these disarticulated global supply chains had to be restored, and there a lot of inefficiency, containers in the wrong place, semiconductors in a different place on the planet from where the motor vehicles in which they were necessary to complete the assembly uh, were located. And as a consequence, since you couldn't complete the assembly of new motor vehicles, a lot of inflation in the used motor vehicle market. So there you go. Supply chain disruptions combined with on the demand side, right? So supply and demand, supply chain disruptions, a geopolitical shock to energy markets, and then the collapse of the Ukrainian, right, the breadbasket of Europe, the collapse of uh, uh, Central European grain markets, and a big increase in those prices, compounded by supply chains um, disarticulated in the food space. So that's where the inflation was coming from. Hawaii had 7.5% inflation at the peak in March 2022, and then as of July 2023, you can see more balanced pattern where the energy, food, and new vehicles, used vehicles contributions have actually switched to negative. So the supply disruptions have mostly been resolved, and there's a more balanced pattern of inflationary and deflationary forces that net out to 2% inflation, 2% inflation in Hawaii since the spring of this year, May 2022, and then again 2.1% in July. I'm sorry, May of 2023, and then again in July of 2020. So we're done. We're done with the inflation. It was a transitory inflation, like many of us said it would be, because the aftermath of the pandemic, which was to disrupt supply chains, would be resolved once those supply chains were re-articulated. And then on the demand side, where you had stimuli from monetary and fiscal policy, low interest rates, and checks from the government, those both petered out. The Federal Reserve raised interest rates beginning in the winter, spring of 2022, as those rate increases have been ongoing, and um, and um, the fiscal impulse dissipated as firms that were supported by the stimulus packages and as households burned through and jurisdictions burned through that support. So you see a pattern if you break down inflation. This is inflation. We're looking here at the consumer price index, Hawaii running a little bit lower than the national average, but the same sort of dynamics, same pattern of 1 year up, 1 year down, a goal of 2% set by the Federal Reserve. Well, that goal is set in terms of what's called the personal consumption expenditure deflator, which I've broken down here using data from the Federal Reserve Bank of San Francisco, which splits out the supply and the demand components. So you can see the supply shock coming in and then receding. The demand part of this inflation remains persistent. It's at about contributing about 2%, where these are additive, 2 percentage points. So we want to get that down to about 1%. And the Fed is waiting for that. They look at what's called the core or super core, slightly a variant on it, the core PCE inflation rate, which is inflation taking out the food and energy costs. The PCE deflator has a slightly larger housing component than the consumer price index. And the consumer price index tends to run a little hotter than the PCE deflator. But the Fed's target of 2%, you can see the target had been met for many, many years, decades, really the last 20, 25 years, plus or minus a few percentage points. you can see that the core PCE rate remains stuck at about 4.5%, and the Fed will probably keep interest rates high until it sees evidence that that's receding as well. Now, if you look at expectations for inflation, they went up temporarily, and they've already come back to a range of about 2.25 to 2.5%. I'm sorry, that should say 2.5. That should say 2.25 to 2.5. It says 2.25 to 2.25. This is the difference between nominal Treasury yields and it's the difference between the nominal interest rate, risk-free interest rate, and the real interest rate. The real interest rate is proxied by the yield on U.S. Treasury inflation-protected securities. So they compensate you for the inflation, which means you get a real return. So the difference between nominal and real yields is mostly an expected inflation premium, if you will, right? The bond market compensates you for inflation. There are a couple smaller factors that don't matter. There's an inflation risk premium. Sometimes there's a liquidity premium, but those aren't really acting up here. And so the market's expectation of inflation is well anchored, consistent with the Fed's objective on the Fed's balance sheets, right? When the Fed buys securities, injects reserves into the banking system that provides liquidity to the economy. It did so after the financial crisis in 2008 and in several waves during the course of until the mid 20 teens, trying to sustain economic recovery. It did so after the onset of the pandemic. You can see the balance, right? The Fed buys assets by creating liabilities, primarily banking reserves, or more recently, reverse repos, which are, think of it as like a loan to the commercial banking system, the yellow part of this sliced artichoke heart. But you can see that the Fed has been narrowing that range of assets and liabilities as assets mature and roll off the Fed's balance sheet without replacement. That's so-called quantitative tightening, right? Quantitative easing is that they buy assets, create liquidity, bidding up bond prices and helping bond yields to interest rates to stay low. It's the opposite when those assets are rolling off the balance sheet without replacement. The Fed's not in the market, it's not buying those securities, prices aren't supported as much, and they tend to have a downward tendency. That means that interest rates, which move inversely, are higher than they would have been otherwise. So if you look at interest rates on the Treasury yield curve, so across the term structure of interest rates from 1 month to 3 months to 6 months, 1 year, 2 year, on down the line to 10, 20, 30 year Treasury notes and bonds, you can see all the rates lofting beginning in the winter of 2022 when the Fed began signaling that it was going to raise the overnight rate, which is the blue series here. The Fed held that rate at or close to zero for a long time through the mid 20 teens. It began to normalize pre-pandemic and then had to pull back dramatically when the pandemic onset occurred in March 2020, kept that rate low at near zero, and then has raised that rate 500 basis points, 5 percentage points. So half the population has never lived at a time when the overnight rate went up that much, and when mortgage rates, partly as a result, went up 400 basis points. So this is pretty dramatic. It happened very quickly, but it's also a sign that people are kind of on the same page. Market participants are kind of on the same page because the Fed told us what it was going to do. People began to realign their expectations, and then the Fed did it, and people moved relatively quickly, people in the bond market and so on, stock market. And now we're close to the end, or maybe at the end. You can see the Fed's own forecast, that's the dashed line, the Fed's own forecast from June of this year, saying maybe we go up a little, maybe we don't. This is the bandwidth, is sort of the range of estimates of the participants in what's called the Federal Open Market Committee. And you can see beginning about a year from now, the expectation is that the overnight rate, the policy rate, will come down over about a 2-year period, and that the longer term equilibrium is close to 2.5%, which, if you think it through, would be consistent with a longer term rate. If the overnight yield is let's say 2.5, a longer term bond yield like a 10-year Treasury note yield in the presence of low to no inflation risk, right? Because the Fed's policy is credibly perceived by the financial markets. In a world with little or no inflation risk, the term structure of interest rates would be very flat. That is, you wouldn't get rewarded that much more for, going out on the yield curve for borrowing or lending money, or in this case, lending money for longer, exposing yourself under other circumstances to more risk. And so maybe the 10-year Treasury note yield would be 3% with an overnight rate of 2.5%. I'm, just ballpark, and which means the mortgage rate could be less than 5%. Now, right now, mortgage rates are higher than that, and we should think about why. The current move, the move of the last year and a half, 2 years, year and a half really, in the overnight rate, which you see in this heavy dark blue line, that 500 basis point increase beginning in March of 2022 is more aggressive than any of the other moves in the last 30, 40 years, with a couple exceptions. In 1994, 95, the Fed raised rates from a higher starting point. The Fed raised rates 300 basis points, and at that time was able to engineer a so-called soft landing, that is, increased interest rates without precipitating recession. That has been my expectation. It continues to be my expectation, and I think people are starting to come around to it. But it's always been kind of a 50-50 bet whether actual recession would occur. The problem the reason it's difficult to be sure about this, the idea that the economy could simply keep on moving at a relatively modest pace of economic growth with relatively full employment while inflation comes down as a consequence of the Fed and the monetary policy intervention. That scenario is complicated by the fact that there is a credit risk premium out there right now, a pretty healthy one. If you look at the difference between the average 30-year mortgage rate and the 10-year Treasury note yield, you can see how historically they move together. In fact, they tend to move together with a gap of about 1.7 or 1.8 percentage points, 170, 180, 175 basis points, something like that. You can see the average I calculated there for about 20, 25 years, 27 years is 1.67. So a 3% 10-year yield, for example, would be consistent with a 4.67% mortgage rate, which is a pretty good rate. And trust me, we're not going back to 3 unless something else disastrous happens. I mean, it took a pandemic to take it to 3, so hopefully we won't go there again. But in the steady state, if you've got overnight money at 2.5 and longer term money at 3%, you ought to be getting a mortgage rate that's less than 5%. And right now the mortgage rate is 7%. So that extra 2 percentage points, I'm sorry, that extra percentage, is it an extra 2 percentage points relative to the equilibrium? But the 10-year Treasury note yield is at 4%, and the mortgage rate is at 7%. Of those 3 percentage points, about half of that is a risk premium, maybe 130, 150 basis points. That risk premium is as high as we've seen, the highest we've seen since the financial crisis of 2008. Now, there's no financial crisis, but there's a perception of risk out there, maybe not lurking as much in the big money center banks, the so-called financially, what are they called? SIFIs, systemically important financial institutions. Yeah, not the money center guys. It's in the regional banks. And this kind of was brought into the open by the collapse of Silicon Valley Bank and First Republic and Signature Bank back in the spring. Now, there hasn't been a contagion that hasn't spread to other banks, but other banks across a lot of the country, in sort of the middle market, do have risk exposure that they're having to manage down because of the abrupt increase in interest rates and what that does to the value of their portfolios and how much of their capital is exposed to that risk. I think we'll make it through, but mortgage rates will stay higher than I would have thought at this point, and than we would have liked. I do think mortgage rates and rates in general will come down over the next couple of years, and that's the Fed's forecast. But I guess we just have to be more patient. Corroborating evidence comes from this is an example of an index of financial stress, and you can see the system doesn't appear to be in as much stress as it was at the time of the collapse of Lehman Brothers. But a higher number is a more stressful environment, according to this Kansas City Federal Reserve Bank index, a fairly well-regarded one. So there's something really out there that's hanging people up, hanging people up. Now, what I've done is I cobbled together these slides from other slideshows, and so it says appendix, but it's not really an appendix; it's actually content. So the flip side of inflation used to be unemployment. Now we in a world where inflation is stable and we're at full employment, and you just kind of stay there, right? What's the inflation rate in Hawaii? 2%. What's the unemployment rate in Hawaii? 3%. If you just kind of stay there with 2% inflation, 3% unemployment, nothing wrong with that, right? Just go to work every day and no recession, and you just keep going. I mean, we have other problems, but not high inflation and not high unemployment. That's not a bad world to be in, but it means that things aren't moving around very much, and historically they have moved around. So let's consider some of that movement as a context for what we're looking at today. Now, there are more than one unemployment rate, and a lot of people, mostly for political reasons, like to cite the higher rates. But the one we all use and always have used is the so-called U3, number 3 out of the 6, which you can see at the time of the last recession here in Hawaii was up around 7 or 8%. If you go back to the 1970s, it's up around 10%. You can see after the pandemic, briefly got as high as 13, 14%, much higher than that on the neighbor islands, which are more tourism oriented, right? 150,000 people lost their jobs during the pandemic out of what, 600,000 that were working. Well, that's like 25% of those working. But again, most of that was concentrated on the more tourism oriented neighbor island economies, not so much on Oahu. The average was, let's call it 14% at the peak. It's back to 3% this summer. The number you're looking at there is for the first quarter. I'm sorry, it's for the end of last year. So we're in the zone, but it has been a weird post-COVID environment. If you look, for example, at these 3 indicators that people used to, normal people, labor economists look at these all the time, but normal people didn't pay much attention to them. We saw, so you look at the bottom series, the dash series, those are layoffs. So, large numbers of layoffs after COVID hit, and then it went back to sort of the background, 1%. In any given month, about 1% of the occupied jobs are subject to layoff because firms are doing well and doing well, and it's dynamic and it's churning. So about 99% of jobs in any given month are not subject to a layoff, but then 1% are, just because of that churn and it's through the normal friction and dynamics of the economy. Quits, on the other hand, which used to be about 2% of all jobs pre-pandemic, rose to about 3% of jobs. Well, that's a 50% increase if you think about it. It's always 2, and then all of a sudden it's 3. So people voluntarily were separating after the pandemic, right? Guys, you should be so lucky to have a job. No, hell no, I don't want this sucky job where I have to expose myself to COVID or something. I quit. That's what people were doing in 2021, 22. That started to come down now. You see that coming down. And then, of course, the thing everybody's been talking about, job openings, which you can see here, rose to 8%, the equivalent to 8% of all jobs. And if you compare it to history, it meant that there were twice as many job openings as there were persons unemployed for the last couple of years, right? There were 2 jobs open for every person unemployed. The relationship between the unemployment rate and the job opening rate is what I'm illustrating here. And you can see historically, it moves back and forth in a range that looks like this, right? Higher unemployment is associated with lower job openings. Lower unemployment associated with higher job openings. It's not unusual for job openings to go up as the labor market tightens up, as the unemployment rate goes down. But what is unusual and occurred after the pandemic was for so many jobs to be open. And a big part of it was just the legacy of the pandemic. People decided, hell no, I'm not going to go back into food service and expose myself. I got to go talk to random people who won't wear a mask and are, spewing food or whatever, right? Those are the kinds of occupations that people say, yeah, no, I'm not working there anymore. But it seems, as I say, going back to the data, that we're settling back in a more normal pattern. And so whatever labor market tightness was coming from those post-pandemic disruptions have started to dissipate. But on the other hand, the labor force participation rate, the proportion of potential workers that actually are working, has come down since the pandemic. It's just not, it never quite got back to where it was pre-pandemic. And historically, we've been for 30 years in this long downward slide, mostly because of aging, but also because if you look between 1960 and 1990, an era of dramatic increases in female labor force participation, right? We transformed culture and society, got to a point where male and female labor force participation was about the same at 70%. But now the boomers are aging out of the workforce. They didn't have as many babies. And so the participation rate or the employment to population ratio have come down. Those demographic factors aren't going to change quickly over the next several decades. And that means that there's going to be a persistent tight labor market, particularly if we don't allow immigration. A couple of things that are always of interest to people in Hawaii: what's going on in the housing market. We talked about high mortgage rates. If you look at home sales on Oahu, both condo and single family sales dropped dramatically when the Fed began to raise interest rates and when the long-term bond yields went up and lifted the mortgage rates with them. Now, if you compare those two inversely related time series, right, you've got this moment more recently where the overnight rate increased dramatically associated with the drop in sales. I suggested earlier that an interesting reference point is 1994, 1995, when the same thing happened. Big increase in the Fed's target overnight rate, big decrease in the housing market. But those of you who are around, if you remember back at the end of the Japan bubble, there was a lot of inventory just dangling, twisting in the wind. 24 months of inventory remaining in 1994 on Oahu. Today, there's 2 months of inventory remaining. So the housing market remains tight. Yes, sales have dropped because of the higher interest rates. And in fact, if you look at these are the home sales again, same as here, yeah, home sales just for the last 10 years. If you look at the trend and then detrend the data and map it against the mortgage rate, and I've inverted the mortgage rate, right? So a higher mortgage rate is going down on the scale. And over here at the right end, a 7% mortgage rate maps into the current sales volumes, right? And a low 3% mortgage rate maps into 3 to 4% is kind of what we had, 3 to 4, maybe not quite 5, over the last decade, or an extraordinary period of housing affordability in Hawaii, by the way. I mean, disregard what people have been saying for 10 years, like, oh, it's so unaffordable. No, bro, this was one of the most affordable periods for home ownership in Hawaii. If you missed it because you're listening to those guys, stop listening to those guys. We need to build more homes. That's true. That's not the same thing as saying that the affordability window that came from having a 4% mortgage rate plus or minus wasn't open for 10 years. It was, and you missed it if you listen to those guys. We're probably going to go back, as I said earlier, to a rate like 5 or 4% or something in between, over the next couple of years, once monetary policy is in a position to ease. And that may take another year. We may have to wait for a year. So maybe beginning next summer, let's say, this situation will change. If you get back to a 4 or 5% mortgage, you can see, you can sort of predict, looking here, what sales volumes will be. That is, it will be below this trend. And the reason is this trend was a golden age of housing affordability in Hawaii. But again, if you listen to the whiners, you missed it. Sucks to be you. Home prices in that period of the late 20 teens were in a very stable trajectory, like an escalator. And if you've lived over here for a while, home prices have been more of a roller coaster on Oahu. So here you're looking at single family and condo median prices, and you can see how smooth that movement was. Basically, like a savings account that pays 4%, 4.5% every year. Just right, owning a house, you pay a 4% mortgage, you get 4% price appreciation, and God lets you live in the house, which is like, right, the dividend yield, right? So you get a 4%. mortgage rate, you get 4% appreciation, so you're totally square on that, and then you get the housing services for which you would have otherwise had to pay rent. And so a really tranquil market, and then came COVID, huge disruption in the pattern of housing demand. And we may have time to get into this next Wednesday at Koala Golf Course, so I'm going to save that discussion for later. But the key thing here to notice is that single family homes went into a kind of a little bubblicious, right? They kind of busted a move that condo prices on Oahu did not mimic. Now, a bubble raises all prices. So something unique to the single family market segment happened. And if you detrend those prices, right, you can see the trend. So now I'm going to take the trend out. So you have, if it matches the trend, there's no change, 0. Yeah. And you can see here in standard deviations that we're talking about a 5, 6, 7 standard deviation move relative to trend in single family home prices on Oahu the last couple of years. It was not replicated in the condo market. So a shift in the composition of demand towards detached dwellings post-pandemic. Think about why, as you think about how I'm doing this on Zoom at home where I've been working, waiting for everybody else to figure out that they could work at home too. Longer term trends in tourism, we haven't gotten back to. I know everybody is comparing to 2019, but that's like saying in 2023 when your son or daughter graduate from college that you're happy that they now can pass their high school final exam 4 years, or I mean, that was 4 years ago. We've moved on, and we ought to be able to perform at a high level of performance. These are passenger arrivals, seasonally adjusted in the upper series, and you can see, and then COVID weekly normalized Hawaii COVID cases per million persons. And each of these spikes is a variant, the Delta variant, the Omicron variant, the BAs last spring and summer 2022. This winter we had XBB, now we have, what is it, EG.5, right? The variants matter, they push down travel, and so they've been preventing Hawaii tourism, again, passenger arrivals in a more recent, maybe the last 6, 7 years, and then a broader time frame going back to 2010, again, 2010, again, in the 20 teens, a very stable path, seasonally adjusted, weekly passenger arrivals over a 10-year period until the pandemic hit, and now a struggle to get back to the prior trend. Same hotels, same vacation rentals, same everything that we had pre-pandemic, and we're operating at about, I want to say 85% of potential. So if you don't want to go back to potential, that's fine. You can be part of the 15% of people that aren't going to get their business back and have to leave Hawaii. Translating passenger counts into visitor days, visitor arrivals times length of stay, right? Some passengers are residents coming back from Las Vegas with COVID. So take out the residents, and now we have visitors and then their average length of stay. So it's a volume measure. Again, nice smooth trend in the 20 teens, the shock of the initial pandemic, and then the variants and subvariants, which have prevented us from getting back to the pre-pandemic trend. Now, some people are happy that tourism is not going back to trend. And those guys, they should be out of a job and they can leave Hawaii. By the way, the Japanese haven't come back. It's not just everything we've been talking about, like COVID. It's also the exchange rate at 140 yen per dollar, right? The exchange rate right now, 135, 140 yen per dollar. The 20 years of pre-COVID history tells us that Japanese spend less, right, when their currency is weak than they do when it's strong. It also means it's more expensive for them to get to Hawaii. So that's what's going on there. Finally, in the long run, coming back, we had this discussion earlier, thinking about the long run. It's important to recognize that COVID, the pandemic, impaired Hawaii's economy in a way that wasn't as severe in other states, except maybe Nevada for the same reason. Heavily tourism dependent states took more of a hit initially from COVID, and are among the states that have struggled to get back to the pre-COVID level of economic activity. Again, I've indexed, as I have in some of these other slides we've been looking at without me making it explicit. But if you define the end of 2009 as 100, so here's 50 states of data, 50 states data. I'm going to start everybody at the end of 2009, fourth quarter 2009. That's the starting point. And then let's see how their economy did relative to that pre-pandemic benchmark over the next 4 years. And there's Hawaii in the bottom 3 or 4, maybe 5. No offense to Louisiana, but that's kind of where Hawaii is. And at the top of the heap, Idaho, which seems like they don't deserve it, but hey, you take it if you can get it, right? They're doing something right over there. And that's sort of the metaphor for the challenge we face going forward, because these big shocks, whether it's a wildfire in West Maui or a hurricane that hits Kauai or a small shock like 9/11 or a huge shock like the COVID pandemic, those run the risk of displacing the trajectory for all time. And here's a comparison of US and Hawaii GDP. Here I've indexed to 2017, which was sort of the last time we were matching US performance. So I've indexed the two economies' GDP trajectories adjusted for inflation, the real GDP. We'll start the clock ticking right over here at the end of, towards the end of Governor Ige's first term. And you can see what happened. Here's the freeway. There's the freeway. You just stay on the freeway, right? You in your Tesla, you get autopilot, you let the AI crash the car into people. And here's US GDP building up a little bit above trend pre-COVID, then getting hit by COVID, and then coming back. And basically, I mean, this is basically the same trend. This is, by the way, this is the Hawaii trend. Hawaii real GDP growth trend, 2010 through 2018, Q2, sorry, 2018. But the index starts in 2017. That's 100, yeah? 100 right here, 100. So you can tell right now Hawaii's at what, 96 or 97? So we're 3 percentage points below where we were 5 years ago. It's 2023. I'm sorry, 6 years ago. 2017 quarter three is 100 and we're at 93. But we're 14 percentage points away, 14 percentage points away from Hawaii's own potential, the path Hawaii would have been on under two circumstances. One, the pandemic didn't happen, but it did. And two, the pandemic did happen and we went back to our potential. Hawaii did not. The US did. So that's on Hawaii. That's idiosyncratic to Hawaii. It's something we're doing in Hawaii, like finger pointing after the wildfire, or how's this one? We don't build telescopes in Hawaii, we dismantle telescopes. Or how's this one? Where the official policy of the state of Hawaii, Hawaii Tourism Authority, in its Destination Management Action Plan for Oahu, I'm not making this up, the official policy is to, and I quote, decrease the total number of visitors to Oahu, end quote. Good plan. Less is more. That's what's going on in Hawaii. And people look at this and say, hey, you didn't adjust for the population. Okay, per capita, in per capita real GDP terms. Here, check it out for the whiners. In 2010, Hawaii had the same per capita GDP as the national average. Let me say this again. In 2010, per capita GDP in Hawaii was the same as the national average. You with me? The same per capita GDP. Whatever we did in the 20 teens, Hawaii did, which started to push us below the national average and then prevented us from responding to the potential recovery post-pandemic, leaves Hawaii today 10 percentage points below Hawaii's own potential GDP per capita and 12% below the national average. So we went from average to 12% below the average in about 10 years. Mahalo. And with that, I'll just remind you, you can find forecasts like this at the Federal Reserve's website, federalreserve.gov. You can check out my colleagues' websites at DBED or at UHERO at the University of Hawaii Economic Research Organization. Everybody has, roughly the same long-term numbers, and there's a little disagreement about the near term, but there's not a lot of disagreement about numerically about what I've been talking about. And you've got a pause button on your, or you've got a mouse or something, you can hit the tab and you can pause and you can read these bullet points. I'm not going to, because that's the end of this webinar. I'll see you guys next Wednesday over at Ko'olau Golf Club. And if you have any questions, write them down now and bring them to the luncheon. Otherwise, I guess I'll see you at Morning Brew in Kailua or down at the boat ramp another time. So aloha and mahalo.